Welcome back to Getting Real, where we go beyond titles and numbers to explore the human side of innovation and leadership. Today's guest, Revant Nair, is the principal and chief investment officer of FMI Tech, one of the first firms to merge quantum physics with artificial intelligence and global investing, exploring the deepest structures of nature, and now uses some of those insights to decode the hidden patterns of the markets. Under his leadership, FMI Tech has developed quantum-inspired systems for portfolio optimization that combine physics, AI, and intuition to help investors grow smarter, not just faster. This conversation is about curiosity, discipline, and how the laws of nature can teach us about money, motion, and meaning. Thank you for being here.
Thank you so much. Thank you. Appreciate it.
Yeah. So I'm really interested. You started in quantum physics, studying uncertainty, probability, the invisible patterns that connect everything. How did that way of thinking change how you approach decision-making and complex systems?
Yeah, I think as a student of physics or as a researcher in physics, three principles get deeply ingrained in your mind, which are essential modeling principles, which I think are useful very universally. One is, parsimony, use the fewest possible free parameters to describe a system that you're modeling. One is falsifiability, create a model that can be falsified by the data, by the real world, and not just tweaked to be able to fit any kind of data. And the third kind of principle that we were taught is that a model should be able to predict something that wasn't an input in the model in the first place. So this notion of being able to predict something out of sample. And we see that the most successful theories in physics, whether it's general relativity or quantum mechanics or Kolmogorov theory of turbulence, they follow these basic principles. Me individually and us as a firm, comprising of mostly physicists, some mathematicians as well, we follow this philosophy and carry it forward to the modeling of markets, which are complex systems, just like a lot of systems we see in nature.
Is there one idea from physics, something that you learned early on that still carries into your work every day?
Yeah. And actually, this is one of the first projects I did in quant finance, which the abstract idea behind that is the notion of symmetry, right? In physics, there's this notion that if you understand all the symmetries of a system, you really understand the system at a deeper level. And in quant finance, we found that price and time have certain symmetries. For instance, there's time translation, price translation, and there's this wonderful self similarity, which is this fractal nature that prices have, which means that if you zoom in or zoom out price and time in a certain ratio, your statistical properties remain invariant. And this was a really beautiful observation, and it meant that we can constrain these option pricing kernels much more easily using these symmetries than traditional methods in quant finance. So I think if I were to say, if there's one idea I carry forward from physics, it's the notion of symmetry and symmetries and finding the symmetries of a system.
You've managed to connect the patterns of nature with the patterns of markets to solve real world problems. So getting back, I mentioned earlier, if you could explain this concept of the fractal or fractal-like structures to a child. You mentioned zooming in and zooming out and price and time. How do those ideas actually help us make better investment decisions?
Yeah. So let's say that you have this particular symmetry, and you also have a few other symmetries, let's say time translation or log price translation and so on. The idea that if you shift time back and forth, things remain the same. If you kind of rotate the time and price axes in certain ways, things remain the same. Those are boosts. So let's say you have this whole gamut of symmetries, right? How does that help us? It's not just some nice abstraction. It's very practical, actually, because, the standard way of doing things in quant finance involves solving a lot of these stochastic differential equations or partial differential equations, which is highly complicated, and it can be very hard to do in many cases, especially where you have non-linearity. How do these things help us? Well, instead of solving those pesky, SDs and PDs, all that, doing those pages and pages of calculations, you just impose all the symmetries that on the system. So you say, okay, we know this symmetry. What does that mean about our pricing kernel, right? This other symmetry. What does that mean about our pricing kernel? so on. So you impose 3 or 4 symmetries, literally 3 or 4 lines of work. And in the end, you have your pricing kernel, which you can use a closed form expression, which you can use to price options. In many cases where it was not possible to do so with standard methods, it's actually very practical and very useful when you actually apply it this way.
Is this specific to options or does it apply elsewhere as well?
Yes. The example I gave was just for options, but uh, it has an application in portfolio optimization across a range of security. One of the papers I published last year, for instance, applies this notion of fractality, the fact that you have this scale and variance, to actually compute our covariance matrix against across a range of scales, which means that we measure risk. Usually, most people in quant finance measure risk at just one scale, which is, let's say, the daily scale or the monthly scale, which they're interested in. So they hedge and optimize their portfolio only on that scale, but it remains unhedged on other scales. So one of the works I did last year actually uses this notion of fractality or multifractality to combine information across a multitude of scales, starting from minutely to 15 minutes to hourly to daily to all the way to monthly, and construct a much more robust measure of risk or a much more robust covariance matrix. And that has several advantages over the standard single scale way of doing things. And this applies across securities and asset classes, whether it's equities, fixed income, or FX, or anything else.
How would you describe the difference between the classic financial models, like ones created by Harry Markowitz, and the quantum inspired approach that you use today?
Good. So the first thing I just mentioned, right, is Markowitz operates just on one scale. Here we take a multi-scale approach, so that already generalizes it. But there are other things, and this is one of the things we're working on right now with one of our LPs, is to generalize Markowitz to include the effect of non-linearities. In today's day and age of AI, like, people think that any nonlinear modeling has to be a black box. Right? They think nonlinear means it isn't explainable, means there's some giant neural network trying to optimize things or trying to learn things. But that's actually not true, right? In physics, we don't use these giant AI type systems. We use fully explainable white box models, and they can still capture nonlinearity just fine. So, one of the other projects we're working on, how to introduce the nonlinear effects into something like Markowitz, which is more of a plain linear approach. So I think, like, some of these lessons and tools from physics can really help us both capturing the multi-scale effects and nonlinearities. And, one thing I'll also just say about that, a lot of allocators I talk to who literally apply Markowitz type mean variance frameworks, they say that they over allocate to risky fat tailed assets. Why are they over allocating to these highly risky, highly volatile, or fat tailed assets? Is because the model isn't accounting for those nonlinearities. It's not accounting for that kurtosis. I think that's one of the practical applications of these physics like techniques, which will help solve that.
Real. Where do you think that we stand in terms of the likelihood of a major shift happening, say in the next 12 to 24 months?
Yeah. I was talking to my CRO, and nothing I say is financial advice. And obviously,
Yes.
we're not experts in predicting crashes or anything of that sort. We run fully hedged long short portfolios. I'm not an expert, no financial advice that I'm giving, but my CRO did mention to me that a lot of the classic early warning signals of crashes, which indicate, like, bubble like behavior, have been surfacing over the last 2 to 3 months specifically, including increased correlations between assets and risk factors, and decreased idiosyncratic movements. And also, there are certain power law type dynamics which are kind of have been emerging in certain asset classes and certain securities. So I think that's what I'll say about that.
Yeah, and I won't push you too far on that because neither of us have a crystal ball, but it's just it's just interesting the environment that we're in where it's a unique place where you could potentially have bubbles happening across multiple asset classes. So
Yeah. And one thing we've seen actually that's a very interesting phenomenon that we didn't see as much in the past is this flip side to the bubble called a balloon. In a bubble, you have, prices going up slowly in an exponential or power law, and then, suddenly they'll, collapse in a very short period of time. Balloons are kind of like these meme stocks or these highly fashionable stocks, some quantum stocks that, or even cryptocurrencies, right? That suddenly spike up in value because of some exogenous effect, and then they slowly kind of deflate, slowly come down to equilibrium. So you have these, positive skewness type dynamics that is, I think, been happening this year much more than you've seen in previous years.
what inspired you to move from studying the universe to studying markets?
So it's interesting, 2015, 16, it was really hot at Princeton to be studying quantum chaos. It was all the rage back then. People were in particular interested in like what's the most chaotic that a quantum system can get, right, or a physical system can get, and subject to the constraints that we have in physics, like unitarity and locality. There is a bound to how chaotic things can get. It's called the Lee-Robinson bound, and there's very very few systems that really come close to that bound. And somebody gave me some financial data. I got it from a friend, and I was analyzing it. I found that measuring the the Lyapunov exponent, right, which is a measure of chaoticity in financial data, it actually exceeds that bound. So it's more chaotic. Financial data is more non-stationary and more chaotic than almost any data set you can see in nature. That really thrilled me, and that kind of challenge was something that I really wanted to take on. That's what kind of intellectually drew me towards quant finance.
Do you think of markets as living systems, adapting, evolving, more like an ecosystem than a machine, or more like a machine than a ecosystem?
That's a very, very good question. I know people who sit on both sides of that debate, and like what are the best models to market to for the market. Obviously, there are like financial mathematicians who model it in a whole lot of different ways. But I think in the last 15 years or so, especially since Andrew Lowe published his book on the adaptive markets hypothesis, this notion of markets as an ecosystem has been gaining more and more prominence. His basic idea was that you have, different agents in the ecosystem, and you have different predator prey interactions between them, and the inefficiencies in markets or the anomalies that we see are a result of these adaptive market type of dynamics and these interactions between agents that live in this ecosystem and interact with each other in a myriad of different ways. So I know a lot of fund managers now, especially in the last 3 to 4 years, who have kind of revived those ideas and who are looking at those ideas very very carefully to try to see if one can actually leverage them for alpha generation or risk management. So I think it's a very fascinating topic of study, and I think a lot more work is going to be done there in the next few years.
Wow. You mentioned earlier, sort of, well, not given your background, I would guess that you have a unique philosophy in terms of building out the culture and building out your team at FMI. Can you explain sort of that approach where I would guess that you're looking for more of a physicist mentality than a typical sort of investment background that you would see elsewhere, right?
Yeah, and I mean, we have hired from other funds maybe once. We hired a quant from them, but not anymore. It was just one time. For the most part, we will hire people who are fresh from academia, who are physicists, mathematicians, or maybe engineers as well, and who view markets as a physical system, as a kind of dynamical system, and don't have any biases about what is supposed to work or what has worked at other funds in the past, and come to us free from that bias. Because what's been happening in this quant industry, which is a really small industry actually, is that people move from fund to fund, and the same strategies have been regurgitated from fund to fund, and that's led to, I think, a massive decline in innovation in our industries the last 10 or 15 years. And what we want to do is inject fresh blood into the system, and I think that's the way we can generate uncorrelated alpha for our LPs, which is truly diversifies their portfolio. And a lot of quant LPs have been telling me that quant funds are becoming increasingly correlated. They all claim to be doing something very unique, but they all go down at the same time. And why is that? Because there's a small sets of strategies which they actually follow, and those strategies kind of become risk factors. So I think it's very important for our industry to hire outsiders again, like we did maybe in the 80s and early 90s.
So outside of that fresh, fresh blood, fresh pair of eyes, fresh mind, what other traits do you look for when you're recruiting people onto your team?
Yeah, so we look for obviously technical brilliance. I mean, they don't need to be the best at doing large calculations, but yeah, they need to have some grounding in mathematics. And they need to be technically sound. They need to be able to code well. And also, they need to have a healthy streak of rebellion in them. So, often the straight A PhDs who, come to us or who go to other funds, they often don't really survive in quant finance, right? Because they're used to reading a lot of the literature and then making like minor incremental improvements on what came before. Usually the straight A PhD types don't really radically question the assumptions and engage in radical out of the box thinking or innovation. So yeah, we do test also for fact that how critically or independently do they think. That usually counts with a healthy sense of rebellion. And one of the my favorite interview questions to ask that kind of tests for this is, what do you think to be true that almost nobody else in quant finance or almost nobody else in physics does? And if they can come up with a plausible answer to that, that means that yes, they do have a contrarian way of thinking. It's a good thing.
Yeah, I love that. When it comes to what you deliver, what are you offering to LPs as sort of your unique value proposition?
Yeah. So I think above all, it's diversified, uncorrelated alpha. And I think a lot of LPs have regressed our P&Ls against those of other quant funds. And they found very low correlation to other quant funds. So I think, that certainly helps. But the other thing we offer is that we completely understand all the models that we make, all the assumptions that go behind it. And therefore, we can explain not just who we are trading against, but we can also explain most of our drawdowns and relate them to certain risk factors we were exposed to or certain assumptions that our models made, which break down. And these are not really that common in quant funds. Most funds, you just create models without knowing who the counterparty, who's on the other side of the trade, right? Who are they making money off? They just blindly create models. And often, a lot of quant models, especially these days, ones based on AI and machine learning, tend to be black boxes. So when they face drawdowns, people can't explain why the drawdown happened. I think in our case, we can exactly pinpoint in most of the cases why that happened. So it's a level of transparency we give them, as well as a level of diversification and high alpha strategies.
I'm going to switch gears to AI. So you lead a team working at the intersection of artificial intelligence and physics-based modeling. For someone outside that world, can you explain in simple terms the difference between an AI-driven portfolio optimization?
Right, like people have tried to use like neural networks or different fancy AI techniques to fit their covariance matrices, or to fit volatility services, and they kind of have applied these for portfolio optimization. But the main difference in doing something like that and creating a model from first principles where what each of the terms means is that you have much more control over a physics inspired or physics based model. You know what each of the parameters means. Therefore, if you want to tweak some things, or you want to respond to macroeconomic shocks, you know exactly how to change the um, the optimizer or the terms in the optimizer, versus if you use a black box AI tool. Often, people will say, okay, the regime shifted. Now we need to train the AI again on a new regime. And then, you wait till you accumulate enough data, by which time a lot of time has passed. And so I think it gives you a lot more control and flexibility when uh, your system is a physics-based white box system that you really understand.
How do you see, I guess, AI impacting the industry at large? And what's your personal take on AI and its involvement in this space?
Yeah, I think AI is having a much greater impact on discretionary fund managers than on quants as far as the whole alpha process goes, right? So in the past, you would have analysts parsing through lots and lots of news articles, SEC filings, earnings transcripts, bond prospectuses, and try to find alpha there. And now you can have AI doing that same job, that going through those scores of unstructured data and essentially converting it to structured data or converting it to recommendations. So I think a lot of people, especially managers, but also like these quantamental managers which are emerging a lot, are trying to do that type of stuff. I don't know. I haven't heard of any runaway success story yet doing that approach, but it's early days. And my hunch is that, um, you know, the model layer has already become commoditized, right? And data sets also more than often become commoditized. So if you have a true edge, it'll be in maybe how you fine tune that model, and what other instructions or what other context you could feed into that model that other hedge funds don't have access to. So, that's far as alpha is concerned. I think as far as risk management is concerned, which is not a zero sum game, I think it's going to have a much more profound impact, not just discretionary, but all kinds of fund managers. Because today, a lot of fund managers consume these old legacy factor models, right, created by Bara or Axioma, so on, which are constructed by hundreds of analysts manually reading the news and constructing those factors. And I think that industry is going to be disrupted big time in the next 5 to 10 years at most, if not sooner than that, because these LLMs are going to go out there, scour the news and filings much faster, and come up with new risk factors that human analysts would take weeks or months to compile. I think LLMs will come up with new risk factors within minutes, and that's going to revolutionize the whole risk factor industry.
Great. And getting back into the business leadership side of things, have you had any mentors throughout your career that have guided you or taught you lessons that you carry with you?
Yeah, that's a great question. Um, First of all, I'll make a point here, which is that in our industry, specifically the quant hedge fund model, right, the whole mentorship concept doesn't really exist the same way that it does for a lot of other investing principles. When people go and work at bigger quant funds, they're usually siloed, usually have some very specific niche role so that they don't get access to vast majority of the IP, right? Because what we create, the IP is so deterministic, one could literally carry it elsewhere. So, it's a much more secretive industry, and, you don't have the kind of like the mentor model that you do in VC or value investing, for instance. But coming back to me, I'll say this, that I've interacted with some exceptional people in the industry who, despite the secrecy of the industry, have been willing to share their insights with me. And one of the reasons I got into quant finance was my long conversations with Peter Carr, who was a professor at NYU. He was a legend in options pricing and other things. He unfortunately passed away 3 years ago. But his childlike curiosity and enthusiasm about exploring kind of the interdisciplinary collaboration between physics and finance kind of gave me confidence as well that, okay, what I know from physics can be applied to quant finance. And just talking to him, like gave me this sense that, quant finance isn't, the canon of quant finance can be challenged, right? And you can inject new ideas, and you can challenge the status quo here. So I think his enthusiasm and curiosity was very infectious. And other people I'll mention had great chance to interact with Gordon Ritter, who's given me some amazing insights into just how to run a quant fund, how to look at risk factors and risk management, how to look at alpha, and so on. He's obviously very successful in his own right. I've enjoyed talking to Igor Halperin over the years, gifted physicist and quant, and Jack Sarkisian, who's essentially the father of quantum finance, who wrote the first book on quantum theory of markets. He's taught me a tremendous deal about how to view, how to model markets, and how to kind of, bridge that gap between physics, like all the subtleties you have to account for when applying a physics-based theory to financial markets. I think, those are some of the
My in my homework before our interview, you have mentioned in the past that your grandmother had a deep influence in your life. Any lessons from your grandmother that stand out or have shaped sort of your life path?
Yeah. Mm, I think my grandmother personally had a more profound influence on me than almost any other human being. And I haven't spoken about this too much publicly, but there are certain traits that she embodied that um, just give me courage and zeal and uh, persistence. And I think chief among them are her uh, sense of lightness and her sense of being able to move on from setbacks without any without getting weighed down by them. So in that sense, she was almost like a true, uh, you know, sportsman, or a true trader, where you can get, get your mind away from the last ball, or the last trade, or the last day, whatever happened, and focus on the future. And I think that's very essential when dealing with stress as a fund manager and also in life. And apart from that, I think it's just her genuine warmth and love and kindness that she embodied. That's a great example for me and the rest of my family.
Genius.
Right. So I think the unifying principles that I laid out right at the beginning of the conversation, right, when you said, what do you carry forward from physics to finance? I think those are some of the key modeling principles that we insist everyone sticks by, no matter what realm of physics or mathematics or engineering that they come from. We want them to follow principle of parsimony, principle of falsifiability, and to predict more than was input in the models in the first place. And uh, you know, apart from those broad abstract principles, we have the same strategy approval process for anybody submitting a strategy in the fund. So it has to go through the same rigorous process. There are certain things that have to be checked for in terms of, how is it overfitted? Is it not? How does it do out of sample in different cases? Uh, what are the assumptions behind it? What are the conditions on which it works and doesn't work? How does it do on pure noise, and so on and so forth? So this is a universal set of standards that everything must pass through, no matter where it comes from.
When you look back at your journey from physics to finance, what are you most proud of?
I think one thing I'm most proud of is, I mean, it's early days, we're still growing rapidly, but I think I'm proud of the fact that we have stuck to those age-old modeling principles. We've stuck to our principles regardless of what's going on in the outer world. AI has become very fashionable. Black box models have become fashionable, but we have still stuck to a certain way of doing things and constructing models, and built a team around that. And I think that's what will give long lasting value to our employees and LPs going forward.
when you look at the next 6 to 12 months from a business standpoint, what are your aspirations and the biggest challenges ahead of you?
Yeah. So I think from a business perspective, obviously the aspiration is to reach more investors, grow AUM, scale accounts, and also to really put into place certain um, risk management techniques that uh, we've been pending. So, for instance, we greatly improved our factor hedging now, and we want to put that into production. We have certain other proprietary risk management tools that we're going to put into put into production, but everything in the service of generating higher, better, more uncorrelated, risk-adjusted returns for LPs.
One, two last questions for you. What advice would you give to your younger self? You're just graduating from your undergraduate. What advice would you give yourself about entering the world of business and investing?
The advice I would give is um, essentially to think more from first principles, question every single thing, including everything that really smart professors tell you or that people have assumed for generations, to get to try to reconstruct or reverse engineer models from those first principles. So I think if that's something I've kind of learned more over the years, and I wish I knew it more back then.
I end every episode with the same question, which is the name of the show is called Getting Real. From a quantum perspective, from your unique view of the world and our reality, what does getting real mean to you?
Yeah, getting real means I think completely authentic and unabashedly authentic, and I think it's very very important, especially in today's world where the Gen Z and so on are growing up with social media and AI and all these different levels of self-awareness, which I see in younger people and younger students are declining. And I think getting real is like getting back to your roots, getting back to yourself, knowing what your goals are, knowing what you want. I think that's what it means to me. I think that'll sort of get a lot of people more ahead in life, for sure.
Well, I can't thank you enough for joining the show today. A rare mind, Revant Nair, who reminds us of the same patterns that shape our nature, also shape the economy, the markets, and even us. From fractals to ferns to fluctuations in finance, his story reminds us that truth hides in repetition and that curiosity is the bridge between science and wisdom. I really appreciate you getting real with us today and sharing, the business side of things, but also the science and the personal side. So it was a fun conversation.
Thank you so much, Dan. I really appreciate it. Enjoyed
Thank
it.
you. Hope that went well. I'm gonna just stop us there.